Hey folks, and welcome to the Pipnotic Symposium for the 7th of May 2024. I had a request come in. A lovely young lady asked me to talk a little bit about how to use the software in varying configurations and how you could perhaps use it to take advantage of trading opportunities on perhaps a slightly smaller time frame. So we're going to talk about that today, and I hope that this video helps clarify a few things. Okay, so what I'm looking at here, this is the 1 hour chart, and we have the daily chart here. And so I'm not just looking at one chart, but I'm actually looking at two charts. And the reason I like and actually prefer to look at more than one time frame is because if you're looking at one time frame, for example, the 1 hour chart, it can often be easy to overlook what's happening on the bigger time frames, which essentially is the time frame that tells us where the major flows are moving. Okay, and of course we can see here on the daily chart that we have moved off this daily demand just here, and we are moving up into this this little price nodule here where we could expect prices to react and move away from. Okay, there are no guarantees, but it's just a very good habit to get into, to have a quick glance on the greater time frame, just so that we know what is more likely to happen on the smaller time frames than not. All right, so I have, let's say, a daily time frame. This is just an example. I normally use 3 time frames actually, but today, for the sake of simplicity, we're just going to use 2. So we have the daily chart, okay, which is the trend or the macro view, if you will, and then on the smaller time frame we have a smaller time frame. This can be the half an hour, the 1 hour, whatever, it doesn't matter. A time frame that enables you to identify entry signals. And so what I like to do is I like to pay attention to several different things. First of all, I want to know where price is on this on the bigger time frame, because this is showing me typically where we have a directional bias. Okay. Also, I want to know what is happening relative to the cycles. Okay, and you can see here that we have just completed a bear cycle, which commenced here and ended roughly here. Okay, and you can see at the bottom, if we go straight up, it takes us to where this low is just here, more or less, at demand. This is a very big deal. Okay, we need to know that price is actually feeding into a very liquid area in the market, because this is going to give us a bias on our smaller time frame, which is the chart to the left. Okay, so first thing to do is to gauge an understanding. Where are we now? Are we at the beginning of a cycle, or are we at the end of a cycle, or are we something entirely different, and that is in the middle of a cycle? Okay, because these are important things to understand. When we are at the top, we can expect prices to go down. And when we are at the bottom, we can expect prices to go up. Okay, so if the histogram is low like it is now, and we're starting to print these little dots here that are telling us that there is a disconnect between the price of this asset and the underlying value, well, then we know that there is a very high likelihood that prices are going to start to seek liquidity, which is going to be higher in this situation. Likewise, we have prices that are high on price, but also in the histogram, we're starting to print these little circles that are telling us that we are seeing, once again, a disconnect in the price of this asset and the underlying value. And so we can expect prices to move down. Okay, so currently you can see that we are at the end of a bear cycle, but price has already moved. And what does that mean? Well, that means that it's maybe a bad time to do anything. Okay, ideally what we want to do is we want to see this. We want to see prices reach a zone. Let me zoom out a little bit more so we have more data. We want to see prices move into a zone, and we can see that we have, once again, we have an area of consolidation. Okay, this is a price sensitive area. We have an area of supply here that was tested several times, once, twice, and then maybe 3 or 4 times over here, and then prices finally moved away from it. But the liquidity base is down here. And the reason I know that is down here, because this is where we had prices consolidating before prices went higher. Another clue that is very, very subtle and very, very important, and that is this one right here. This is really, really important and something that you need to train your eyes to see. Because when you have a zone like so, prices come down into that zone and they start to trade sideways. What's happening here? What is happening when prices move into a price structure like we can see here? Well, what's happening is that we have a window, okay? And this is where prices meet demand. Prices come in, so we have the active participants in the market, the people who are already engaged in the market. Prices come down and we start to move sideways. And when we don't know what direction price is going to do. Maybe prices, in fact, they went down from here. We don't know. You only know what is going to happen after it happens. And you know that it happened here when prices left away. But this is key as well. Okay, and so what we can see here is we want to be aware and alert when prices start to move sideways like that. And you want to look out for these little price structures like so, when prices jet below and then move back into a range, because that is telling us something very interesting and very subtle and important about the current appetite for price, the current and the future direction of price. When prices deviate from an agreed price window, so people are happy trading to one another within here. How do we know that? Because they stay within the range. People are happy buying and selling. This is a relatively maybe low volume market environment. People are happy in buying. There's a relative balance between the two. Then all of a sudden prices dip below and then they move back into the range like this. When this happens, what is the purpose of this? What is the purpose of that? I'll let you think about that. Maybe pause the video and have a think about what the purpose of this price structure is just here. Well, the purpose of it is when prices move, you have to understand why prices always move. And prices always move in an attempt to seek liquidity. Okay, so when prices jet lower, like you can see here, and they come back, well, that's telling us that the move down was an attempt to seek bids, to feed into bids. And you know that because prices move back into the mean. Not the mean, but the range here. Okay, and when that happens, that is telling us that the most likely price is higher. Because prices come down, we seek bids, we find them, and we know that we find them because we move back into the range, as we saw right here. Okay, and then when that happens, we can prepare ourselves for prices to move higher. And you'll see that all over the place in lots of different situations. But they're most effective and the most interesting and valuable when they happen at a time where you have the histogram that is at an extreme above or below the red and the green line, and also at similar situations where we have this, prices come down below and they move back into the range and they move higher. So we know that this is an attractive price window for buyers. Seek liquidity, we snap back. We do the same thing, we consolidate. We seek liquidity, we snap back. Okay, so when this happens, we know that this is an attractive price window should prices return to it in the future. So what you do then is, first of all, you have to find these areas, and they're not that difficult to find. You just have to look for a situation where prices move down to an area, they move sideways, and then they move away. Okay, so you form this little sideways price nodule. This is the bids. Prices feed into the bids, and then prices move away from that period of consolidation. Okay, so super interesting, very, very important, yet very easy to overlook. All right, so we have this situation here. We project that into the future because we know that there's an interest to buy at these prices. Prices come down to that price window here at a time when the histogram is telling us that it's time to buy. And the next question that I'll answer is, what is the histogram actually doing? How do we know that when prices come back here, that they're most likely to move off and away from that area? And what the histogram is doing is it's calculating a value for the asset. This is the pound British, the pound American dollar. So it's calculating a value of that based on some simple mathematics, and then it's looking for when prices move away, they deviate from an expected and agreed price of trading or price window of trading. So when prices move away from here, this is a very nice place here. People are happy buying and selling here in the middle, but when prices move away and they start to move to these extreme prices like so, I mean, what happens? I mean, prices very often move back towards the mean. Okay, so this is essentially a mean deviation tool. And so when prices move away like that, and they do so at critical price points like so, there is a very high likelihood, as a matter of fact, well over 80% likelihood that the prices are going to move back towards the mean. And so when you see prices doing the same thing here, oops, that wasn't very good, here and here, while we do get reactions, these do not look like there is any basis for buying historically, so looking to the left. And so you want to pay attention to the convergence of price with the histogram. This is super important, which is essentially why I developed the supply and demand software, which is this one here, and the histogram, because they can be used together. They can marry very, very beautiful. This is a beautiful marriage when you marry supply and demand with a deviation tool like the one that we have at our disposal here. So what I like to do is I like to understand these things. And so when prices come down, let's use this as an example. Prices come down. They come down to here. We move into an area of demand. Prices look like that, which I like very much. And then they start to move up. They start to move positive, get increasingly more positive. Then I know it's time for me to pay attention. Okay, and so then I have to go to a smaller time frame. Let's go to the hourly chart. And let's study the price structure that occurred. And this is the price structure right here. This is the one that we just saw. What I want to see is I want to see a very specific pattern. I want to see prices do something like this. Form a low. I want to see a lower low. Then I want to see prices move away like this. And I want to see I want prices to come back like that. So it almost looks like an M. Like that. But often, well, actually always, you have the M where the trough is lower than the other two, and the other hump looks like that. Okay? So this is what it'll look like on the bottom. Something like this. And the reason this is important is because we have the same thing happening once more. We have this little price structure. Prices move away. Then they move back higher, and then they leave. Okay? So essentially, it's a little bit similar to what we saw on the daily chart, where prices move down into, we move away, we come back, and then we leave. Okay, this is essentially the same as this. We want to see that that attempt, rather that we want to see prices seeking bids, and we know that we have this because we have a similar situation going on here on the smaller time frame. We know that prices are poking into daily demand. That's a big one. That's a real biggie. And then we see price exhibit the behavior that we know is important in relation to the underlying state of liquidity of this particular market. Okay, so a very important thing. So what I'll do is I have my 2 or 3 time frames like so. I wait for prices to move into that zone. okay, like we see just here. And when that happens, then I'll start to look for that pattern. So if we go here, this is a smaller time frame, smaller yet, and we have it here. We have prices go down, they go up, we move back into the range more or less. We do the same thing again. We go up and we come back. So as a matter of fact, we have the bigger pattern, which is actually here, and inside that we have another one. Sideways, prices go up, they go down, they go up, and then they come back. So this is actually what we can refer to as a fractal pattern. You know, the visually mathematical models, the fractal created by what's his name? Was it something Mandelbrot? And this is a pattern of self-similarity, almost like a hologram, where each piece of the picture contains, or rather each piece of the small picture contains all of the pieces of the bigger picture. And the more you zoom in, the more you see these patterns of self-similarity emerging. And they can go on for infinity because it's a recursive function. It goes on forever and ever and ever. And if you don't know what a recursive function is, just Google it. It's a fascinating concept in programming. And so what we can see is we can see that happening. We have the macro pattern, then we have the micro pattern emerging. When you see those happening, it's a very beautiful thing converging. And so what I like to do is I like to wait for these things to happen. So I mean, I probably wouldn't have done anything according to the macro pattern, but what would have tickled my fancy was this one here. I saw the sweep lower, and then prices came back more or less to the same price window, and then we saw prices race lower, move higher, and then move down like so. Okay, and they're doing this at daily demand. Okay, so this is something that is super important to understand. Another thing that I think is paramount for your trading success, that is understanding that not all of these zones are created equally. Most of them are going to work out very beautifully, but some of them will not work out. And this is because if you take a level or a zone rather, and it doesn't work out, it's normally because there was no attention paid to context. And let's find a few examples of that. Okay, here we have a zone here. Okay, we have a zone right here. Prices are exploring, they're seeking liquidity lower and higher. What you do not want to do is you do not want to trade the ones inside these. And the reason you probably wouldn't trade these is because if you're paying attention to what's going on the major time frames, then these you will not even see. This will just look like, for example, a 4-hour period of distribution where prices come down from above. We go like this, we move down, we snap back, we move up, we snap back, we move up to supply, we have it right here, and then we move away. Okay, so you would not trade these little ones inside the box. You would be mindful of them because they can have merit, and in fact they can work. Like this little one here, we had a little area of supply formed, prices left, prices came to the edge of it, and we moved away. But you would not want to trade that. Additionally, we have this one. Prices went higher, and then they came lower and tore through it. You'll probably find that this is a similar situation once again, where we have prices moving sideways, seeking liquidity, reverting back to the zone. We go above it, and then we go down very, very quickly. Okay, this is within a greater framework of price, and so you would not pay attention to this. Also, this one here is uninteresting to us. Why? Because prices have already been to this area. They've already been here. They've already been trading in this area throughout this entire period here. Okay, and so you have to pay attention to context. This one here was traded here, but it's within the context of this greater price framework, as you can see just here. So really try to pay attention, and that's the whole point of trading multiple time frames at the same time. You need to be able to understand what's going on. And if we have a look at what that might look like on a smaller time frame, sorry, on a bigger time frame, you can see that the prices were here. They were moving sideways. And this is looking very much like we saw in the previous example, seeking liquidity, supply. Okay, so prices poked into here. Okay, is there supply down here? There's actually an area of supply, but it's been tested once, twice, 3 times, 4 times, 5 times, 6 times, 7 times, 8 times. So would we be confident in buying here? Would we? The answer is no, we would not. Absolutely not. Why? Because prices are testing daily supply within a framework like so, where prices are moving below and above. Where did prices revert to? Supply. Okay, is there anything in here? There's nothing in here. There's nothing in here. The major move is from here to here. This is a pullback. So the major flows are moving down. This is a test. This is a retracement. Profit taking from shorts maybe. The continuation is lower. Okay, so maybe that's a lot of information, I think, in one video, but this is very, very important. And so what I like to do to try and simplify things just a little bit is I really like to pay attention to scenarios where we have the histogram doing the same thing on multiple time frames. And as a matter of fact, the ASR algorithm does just that. It's looking at situations where we have deviations from this agreed upon value and price construct that I calculate. Prices go down, we're deviating. What's going to happen? We're likely going to move higher, and then here we're very likely going to move higher. And I like to combine that with the same thing, but on the smaller time frame. I like things to overlap, and the ASR does just that. It's just it's waiting for a pattern to occur on the bigger time frame. So what it does, it says, have we deviated from the mean? Yes, we have. Okay, let's check the small time frame. Are we deviating from the mean? Yes, we are. Cool. Are we beginning to turn around? Yes or no? Yes, we buy. No, we wait until we do. Okay, so it's super simple. Yes, and so I encourage you to spend more time on the major time frames. So start your analysis on the major time frame and work your way down to the smaller time frame. So when prices move down to an area of demand like this one, and this one is interesting, and it's very interesting for a very specific reason, and that is this. We came up here, we turned, we accumulated, and we left. Okay, and prices came down right to the area, right to that zone, and then we left. What you want to see is you want to see prices attempt to breach an area or test an area several times. Let's just draw a visual example like so. You want prices to move up to an area, move above it. You want them to test once, twice, then you want them to move through, and then you sell at that zone. And this is the reason we leave these zones on the chart. We have this one here. It was tested here. We had a nice reaction. Prices moved through it. Where did price come back to? It came back to the zone. Okay, and so now this zone becomes a zone in the future. Okay, tested, breached, tested, 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 breached, and now prices came back to it. As a matter of fact, prices came back to it on the release right here, and they moved away here. Okay, and you can see the same thing here. We have a little zone right here. Prices tested, tested, breached. Where do we expect prices to go to? Well, roughly the same area in the future. Prices came to it. We moved a little bit closer to this liquidity base, and this is where we moved away from. Okay, so if I just make some steps, number one, that is go to the daily chart and look for the histogram at supply and demand. When you see that, you go to step 2. What's going on here? This can be, for example, the 1 hour chart. We want to see the same thing occur. Plus, we want to see the pattern. Okay. This is at the bottom. This is at the top. Okay. So this is a sell pattern, and this is a buy pattern. Okay, very important. And then we wait for that to happen on this time, on the smaller time frame, and then you can get in generally with a market order. Sorry, a limit order at the zones that the software finds for you. And if you do not find the zones, then you look for logical areas like this, zones that have been tested numerous times. Then you want to trade the zone as price moves away and then back into it before it leaves. Okay, so look for those places where you see tests, failure, test, failure, and then finally prices move through, and then trade that as prices continue moving down. And the reason this is important, a final note, is because if you have an area of supply or demand like we have here, we know historically that this is a very strong area. Why? Because it held and prices moved very quickly away. But you can see as well that prices came down to it, but we did not see that volatile move away, did we? We saw only small moves away, and then another move into it, another move in away, and then another move into it, and whatnot. And so when you see the price behavior on the approach to a zone, this is telling you something about the strength of this zone. And so if you have a zone like so, prices are, let's use actually the rectangle tool, prices move away. Okay, and then prices come back. If prices move with big candles towards the zone, and then the candles start to get smaller when we reach the zone, and when they stay small, this is normally an indication, depending on what? On context, that prices are likely going to break through the zone just here. Okay. All right, that was a lot of information, but I hope it was useful. If it's overwhelming, just take it in small bites and apply each of these one at a time. Start with the daily time frame, mark your charts off, get on a demo account, and take the trades. Don't worry about winning or losing. Just worry about engaging in the market in the way that we describe here in this 3-step process. Okay, good. Well, I'm going to leave it at that. Thank you so much for watching. If you have any questions, please don't hesitate to reach out to me. Thank you.